Ankur, great to have you on, man.
Thanks for having me. Excited for this.
So you have built a number of companies. I've researched you a bunch. Your biggest outcome reportedly was 250 million. You sold a business called Teachable. Now you're working on a business called Carry.com. Um, Really cool story, really cool background. And you're an immigrant, which me too. We support immigrants. Um, I have a lot of listeners who are business owners and who want to sell their business one day. I'm curious, how did you prepare for selling Teachables? Like, where was your head at? How are you thinking about it? And then maybe we can go into things that you would do differently.
The funny thing is, I read a quote about how businesses are bought, not sold, and that was 100% true in our case. I was not looking to sell Teachable. It had been about almost 7 years running the business. We're closing in on 25 million in recurring revenue at the time. But the whole thing came inbound. We had a meeting with a private equity firm, General Atlantic, where the number two guy at the fund sent me an email saying, "Can I drop by your office?" If you know anything about private equity guys, they don't come to your office. They'd want you to go there. So I knew something was up, that he wanted to come to our office. But he dropped by our office and he just mentioned there's this company in Brazil that does what we're doing at a bigger scale. We should just have a chat. He almost set it up like a blind date. Go to dinner, see if you guys like each other. And very early on, we found good chemistry and it therefore made sense to sell. But I wasn't running a process. I never planned to sell the business. As soon as I validated it was a good enough price, that was honestly good enough for me. Good enough price, good enough buyers. Then it just came down to the nitty gritty of like actually structuring the deal and getting it done.
General Atlantic investor, one of your investors, one of their investors? Like, why was he thinking
One
about you?
of their investors. So this company is fascinating. The company that bought us, they're called Hotmart. They raised $400,000 like 15 years ago in Brazil. Couldn't raise money after, it's a bad market, so had to grow just from profits. Eventually, they raised $100 million round 10 years later from GA. And then General Atlantic is the one that helped them structure the deal just because, again, they're first time founders and GA took a very active role in negotiating the deal. They were sitting at the table, all of that.
And I guess what about that process was surprising or unexpected for you?
Pretty much all of it, but a few learnings in no specific order. Uh, I was surprised. Like in my mind, I thought you're structuring an acquisition and it's really like you versus the buyer. But at so many times we found out we had to kind of team up, and it's both of us trying to push the lawyers faster. Like lawyers would just spend so much time, fighting their own little pissing contests, negotiating terms that don't really matter. So that was one learning. The other learning is it's so distracting. It's like the hardest thing in the world because you have to go into these meetings and away from the office. The the range of outcomes, like either the deal happens and I make an infinite amount of money, or I go back to running my business every single day. They're two such different outcomes, yet you have to stay outcome independent, which is like the hardest thing in the world to, because you have to be prepared to walk away from the deal. Otherwise, you've already lost it. So that was challenging. Also, I found that I had to advocate for my team since they weren't actually there in the negotiating table. And there were a lot of times, they'd want to trade like employee vesting or bonuses or all this stuff. And it was my job to fight for it because I'm the only one there representing them.
Did you tell the team or did you withhold it until after you guys closed?
Like it's so distracting for me. I tried to withhold it from as many people as possible. So it was me and our CFO for the majority of it. At some point, we had to bring in the rest of the leadership team, but the whole company, we only told them when the deal was done.
Did the different stages take between, we had our first meeting, they maybe put a term sheet in front of you guys, I assume, to actually closing?
It was actually remarkably quick from the first meeting to a signed term sheet. We met for dinner in late August. And at this point, it was literally just a dinner. And we had a fully signed term sheet by middle of October. So pretty quick, bigger picture for the scale of deal. But from that point on, it slowed down. From the middle of October, we didn't close the transaction till March. And a lot of it was bullshit. It was like legal structuring. I mean, they were a Brazilian company with a Dutch entity. We're a U.S. Delaware C corp. Tax took probably like 6 weeks to figure out, and all of us were doing it for the first time. So eventually, in March, I almost I basically said either we get this done or I want to retrade on price, and that was the forcing factor to move it forward.
Yeah, that's actually really interesting. Were there times in the deal where it almost fell apart, where you just felt like that, there's no way forward, or this isn't working out?
It never got to a breaking point, but it definitely got to a point where it's like, what are we doing? It feels like we're going in circles. We're sitting around, we're having these meetings, and by the way, they were flying up from Brazil every time. Like I still remember one of the partners from GA, he basically alternated New York, Sao Paulo, New York, Sao Paulo 4 days. He would take a red eye every night because he had to be in the other city in the morning. And it was just a crazy life that we're living. But I guess in P, you're used to that kind of stuff. But at some point, I was like, guys, we're staying in this room. We're not leaving till it's done. And over the next 3 days, we literally didn't leave this Midtown law office until we hashed the whole thing out.
These transactions are crazy for a variety of different reasons. Like you said, one, it's usually you as a founder's first time doing it, right? So like the first time I bought a business, I totally deferred to the lawyers, and they just ran in circles and circles and circles until at some point I was like, wait, you guys are supposed to be the professionals, but that's not what's happening here, right? Like you're totally burning daylight. You're going to ruin this deal for me. And now my methodology with lawyers is I'm super hands-on. Like I have the reins really, really tight, and I tell them exactly what I want them to review. And anytime they kind of get out of bounds, which they're likely to
Yep.
do, I kind of I like push them back in. Like, nope, we're not.
And everyone talks about, right, like lawyers, it's in their best interest to let a deal go on, which of course it is for billable hours. The other thing I found interesting is lawyers are also pretty competitive people. They were also fighting for a lot of clauses, not even for billable hours, but love of the game. Like they wanted to feel like they're winning this little battle, and it's things that neither party really cared about.
A lawyer $1,000 an hour, and they're taking like a word from the end of the sentence and putting it to the beginning of the
Absolutely.
sentence, and you're like, no, don't do that, please.
Yep. And the other crazy thing that was happening during this process is we ended up signing the deal on what was the biggest stock market crash in history. This was March 2020. So there was massive uncertainty and no one had any idea how it would go. I mean, we all knew we wanted to do it, but it was just a crazy time in the world. We then announced the deal on Tuesday, which then became the new biggest stock market crash in history. I think that Tuesday was the Tuesday, if you recall, where Tom Hanks said he had COVID and the NBA shut down, and things were getting pretty real.
Grow throughout the process from LOI to close, or was it pretty stable? How was the
We
business?
grew from 20 to 25. Like we were at about 20 when we signed the term sheet, 25 by the time the deal closed. But what's crazy is we went from 25 to 50 in the 4 months after the deal closed because of like macro COVID, like this massive pull for online education.
Yeah, were they pretty happy with the purchase at that point?
It comes in phases. At that point, they were thrilled. Now it's been a harder path and it eventually kind of normalized. But at that point, they're like, this is insane. Like, we just timed this beautifully. And on my end, also, like, I never regretted it. It was time. And, just running a company for that long, there are a lot of benefits of, handing it off.
You weren't thinking to yourself like, oh man, like that could have been a $500 million exit, or something like that.
A small part of me thought that, but every time the bigger part of me is like, don't be that guy. Don't be the rich idiot complaining about how much more money you could have had. Like, I'm already in the 0.0001% of like good fortune and good luck. Don't be that guy. So, that's always been my inner voice.
But yeah, I like to hear that. Would you have done anything different looking back on kind of what you know now? Obviously you talked about controlling the lawyers. Anything about like talking to the team or how you structured the deal?
In general, I feel pretty good about it. Like, again, we haven't done this often enough to really, have multiple data points, but most of it went pretty smoothly. Like, we got the money in the bank. We had two subsequent payments later on. One of the things, the other thing we negotiated for is none of my equity from the earnout was vesting, which helped a lot because eventually I did walk away from the business. I structured my deal as an employment contract, and I was able to walk away from basically millions of dollars of equity. But to me, that's the whole point of having money is being able to have the freedom to walk away from things like that. So that part was fine. And I think the thing I feel best about is they're just good people. And I've talked to so many founders who've just had a nightmare after the acquisition because the people they sold to are just not good, kind people. And the people I sold to are just very good people.
So, I'd love to hear that. What was the structure of the deal? It sounds like there was some cash up front, multiple payments that came along the
Yep.
way. What were the different like percentage?
Every shareholder, excluding me, was bought out in full. I was the best. I could choose a percentage with the maximum percentage cash I could take is 50%. So for me, it was 50% cash, 50% equity. Every other shareholder was bought in full. Our largest investor negotiated to have all stock and invest an additional $10 million into the deal, into the combined company. So just kind of baller. And yeah,
Who was that? Who was the
Accomplice
largest?
Ventures. But look,
Okay.
they're a venture fund, and for them, whatever, like $10 million, $20 million is it's a big fund size, so it makes sense.
And then you were the largest shareholder in Teachable
I was the largest shareholder.
individually.
Yes, I
Okay.
I'm. We didn't raise too much money at Teachable. We raised $12 million. We still had nine in the bank when we sold, but as a result, didn't have a lot of dilution. I owned over half the company personally in common stock, as well as 2 out of 3 board seats. So it was completely controlled it.
What were the follow-up payments if you took half your cash up front and then you had other payments come down the line? What were
It
those?
was it was just like escrow and deal, like in case something went wrong with the deal or some of our representations and warranties. It was like I can't remember the numbers. It may have been like maybe 5% held back. It wasn't a ton. 5% off the 50%.
I read that you guys raised not a ton of venture capital for the size of exit that you had, and it actually looked like you didn't even spend most of it. I read maybe you raised 12, but you had like 7 to 9 in the bank
Yep.
still when you sold. Did you regret raising venture capital, or would you have done that differently?
No, I think because we raised venture in a very different way, like the last round before we sold, we raised 4 million on a 130 pre. Like I don't care about 3% dilution, like it's irrelevant. But that was with that round, we bought in like the CEO of lynda.com, Toby, the founder of Shopify, one of the early board members at Squarespace. So we got all these amazing people on board, and the dilution was minimal. I feel fortunate in that, like now I'm running Carry, which is a much more capital intensive business. A lot of businesses don't have the opportunity, but I love the idea of like raising one big venture round and then trying to get to like break even or whatever. Our own operating model was we were always 3 months away from profitability. If we didn't hire anyone for 3 months, we'd break even, and we kind of kept floating at that stage.
Um, what, I always have entrepreneurs come to me and ask me, when should they take secondaries or when should they sell the business? And I have kind of one diehard methodology, which is always take secondaries, and if it's life changing, always sell the business. I'm curious, what is your perspective? I'm sure you have a lot of entrepreneurs that come to you and ask a similar question.
Yep. I've never taken secondary, but it's because I've never had the opportunity to. In general, I'm a big fan of founders taking secondaries. I think you have all your net worth in this one highly volatile asset. Like it's totally fair. The only thing I tell founders to do is if you're taking secondary, I believe you owe it to your early team as well. And some founders disagree, and that's fine. But I think when it comes to early employees, I personally think a lot of like employee, let's say 1 to 5, I think they're quite undercompensated bigger picture. I think they take on a fair amount of risk, not as much as the founder. They're taking a lower than market salary, and I think they should be given a little bit more. And part of that, I think, is when you're taking secondary, just offer the same percentage. It may not be that much in dollar values, but if you're selling, 5%, allow every employee with vested stock to sell maybe even 5% of vested. That's not a lot of secondary, but that still is very meaningful from like the founders cared enough to make sure, we had the opportunity as well. So that's sort of my only rule with secondary. I think but otherwise I'm all for it.
Bring the team along, get everyone in the same boat. That's awesome.
Yep. That's definitely been a
Uh,
learning going from company one to company two, where I think we've been much more generous with equity the second time around.
Actually want to dig into that. So you sell this business, then it sounds like you went on a bit of an eat, pray, love tour, um, became an angel investor, raised a little bit of capital, started investing in businesses. And I actually went through a bit of that journey as well. So I know what that's like. And then it sounds like you got tired of of just being an investor and you wanted to jump back into the seat. Tell me a little bit about Carrie and what you're doing today.
Yeah, absolutely. So right after selling Teachable, my day to day didn't change much. The real sort of inflection point I felt and how I felt was when I stopped being CEO. And by then I was so burnt out that like walking away from Teachable, I was like, I'm never going to run a startup again. Like, why would I run a startup? It's so much work. It's so much pain. Started traveling, ran a venture fund. Eventually, the venture fund got relatively large. Our second fund, we'd raised over $70 million because, again, I'm a competitive person and I'm like, if I'm doing this, may as well do this big. But soon found investing to be a little bit passive as an activity. And I started to, it's like annoying how nostalgia works because as time passed, I forgot all the painful parts of running a company and I only remembered all the fun early days and eventually knew I wanted to, get back in it. I mean, I sold Teachable at 31. I was, started Carry when I was just shy of 33. It's too young to just be sitting around on a beach somewhere. Um, but I knew if I wanted to start a company, sell the process of going through the acquisition, learning about how our lawyers structured the sale, like saving money on taxes, just made me realize there's so many opportunities in the tax code for business owners, but there's no easy way for most people to actually get access to it. So I knew that was the big sort of problem area we wanted to work in. The specific product took some time and iteration to kind of get there.
Let's talk a little bit about that process. So you've been starting companies since it sounds like since you were 18.
Mm-hmm.
You had some Facebook apps, you had a variety of different businesses. You obviously built Teachable and it took you maybe a little bit of time to get there. One thing I've always struggled with is starting a business and finding product market fit. I find it to be the most painful, difficult iteration process and like lonely, frankly. And I'd love to hear a little bit about how you go about your ideation selection process.
Yep. So my methodology, and I should caveat it with like, this is not the only way. There's a lot of great founders who do it differently. But for me, what I found is starting by building a product that I would use myself. I just find it makes your product development process much faster. And you already have your first customer, and chances are other people just like you who also want the thing. So I did that with Teachable. With Carrie, as I was running my venture fund, I had a small management company. I was making a couple hundred grand in the LLC. And I was just looking into stuff and I found the like solo 401k or 1% retirement plan. I was like, this is actually pretty cool. I can get a whatever almost 70K tax deduction, invest it in any asset I want, like use it to make a bunch of alternative investments, like could set the whole thing up as a Roth where I don't pay taxes at all. How do I actually do this? Is there a product for this? And I couldn't find the right product for it, so I built again the first version of Carry to solve that problem for myself. And as a result, it took us a while for the product to actually get good, but because I knew I wanted it and I knew other people like me who wanted it, it definitely got us started in a way that's very difficult if you're building software for someone who's not you.
Editor to Carry, is it like the old school kind of like Schwab's and similar?
So, bigger picture, Vanguard, Fidelity, Schwab, but very locally, like let's say you want to do a 401k that invests in crypto or real estate or startups. There's a bunch of very old school, like either law firms or, small businesses that kind of do all of this stuff manually instead of technology. But bigger picture, like I'd love to build a Schwab for the modern generation, kind of using tax as our wedge.
Owners, entrepreneurs of any particular business size? Do you have like a range you guys like to
Our
focus on?
sweet spot is like actual small business America, not startup founders, like people who could be making anywhere between 60, 70K on the low end to hundreds of thousands on the high end, not large companies, either sole props or maybe their spouse works in the business or like a very small team. That's kind of our sweet spot. In time we'll expand to other people, but we're like let's focus on that. It also happens to be the exact demographic that Teachable customers were. So it's, in a way a continuation of that mission of like now helping these people build wealth.
Like what's the financial model? How much do they pay?
So right now it's purely SaaS. We charge people either $29 or $49 a month. Eventually, we're also custodying assets. We're applying to be a broker dealer now. Once we do that, it'll open up other monetization in the future. We don't want to charge an AUM fee. A big part of our mission is like, look, AUM fees, like hurt your growth. But as a broker dealer, there's a lot of things. Like I think the assets we custody eventually become the more interesting business later on.
And explain that to me like I'm 10 or 15. I'm not familiar with that.
So let me tell you the business model at Teachable because it's relevant. At Teachable, again, we started out purely SaaS. We charged the creators a monthly fee. The monthly fee was eventually average to $70 a month, but initially it was a little bit less, maybe $40, $50 a month.
Somebody who has like a YouTube channel could come to Teachable and teach a class, and you would charge them, some dollar figure per month for them to set up their Shopify store and be able to sell and reach their community and probably communicate with them. And that was kind of like their business platform. Is that a good summary?
Exactly. So that's exactly where we started. But we also were processing payments for people. And what we saw by year 3, year 4 is some people who would sign up for a subscription would eventually churn, but the customers that stuck around would do better and better every year. And we eventually started taking a small cut out of the payment side by reselling Stripe. We are paying Stripe a lower rate and we're charging a higher rate. And what we saw is as the business progressed, payments became a more and more important part of our revenue. Like year 1, it was 0%. By year 6, it was about half. And then it was eventually growing larger and larger. And if you look at Shopify in the public markets, exact same story. They started with SaaS being their main thing. Now it's mostly what they call merchant solutions. And the reason for that is you want to figure out how does a cohort of customers get more valuable with time? And at Teachable, it was through payments. And at Carry, it's likely going to be the assets we custody. So today we're custodying, a little bit over $50 million, but it's growing really fast because you acquire people when they're young. They're likely going to contribute to retirement for a very, very long period of time. Plus, the market's going to hopefully go up. So that asset base becomes super valuable. And, there's a lot of things you can do to monetize it on the back end.
Some ways a bank. So like if I set up a 401k plan with you, like I'm actually depositing my money with Carry, or is that going somewhere else and you're just facilitating the track?
Yes, we use a custodian on the back end. We use a few different custodians on the back end. Like we use a company called Drive Wealth, and they power investing for like Cash App and PayPal and Nubank and all of that. So they're our primary custodian, but we have other custodians as well. But from our end customer perspective, it's all on Carry. It's a pretty cool brokerage platform where let's imagine you have a Roth IRA. On Carry, you can invest your Roth IRA in crypto, stocks, ETFs, real estate, private deals, all from the exact same place, which no one else has done. Most people do one or the other, not both.
Money, but it's also self-directed. Like I can do all my
Exactly
investing on your platform.
Exactly. Like that's what's a cool thing. Like because most corporate 401k plans have like a few shitty funds with really high fees. Here you can invest it in anything you want, exactly how you want, with no fees.
About like tax stuff with you for days, because I'm also trying to figure out like why is there a rule that says I can't contribute directly to my Roth IRA, but I can contribute to a traditional
backdoor
IRA?
Yeah, and do a backdoor
it. Do you know like why that is? It seems so bizarre, like to have a rule and then have a workaround for the rule.
So the reality is people have this idea that the IRS is like run by rich people and they have all these loopholes. It's like this giant conspiracy. But the reality is they draft legislation. Some smart lawyer accountant interprets the legislation in a very specific way, tries something, that move is challenged in court, and the IRS loses the case. Like if you look at most tax law, that's how it sort of happened. Like even the 401k plan was basically some smart lawyer reading a section of the tax code and kind of building this and then challenging the IRS to kind of prove them wrong. So many loopholes are like, despite the IRS's best intentions, the backdoor Roth being another one. Even crazier is the mega backdoor Roth, where you can use your 401k and get in $69,000 into a Roth IRA every single year, no matter how much you earn. There's so much stuff like that.
Because this is like your second or third time at the wheel. What are you doing differently this time? What did you learn in your go at Teachable that that you've kind of changed your mind on and you're approaching this business differently on?
I think it radicalized certain beliefs I had. Like I always felt like small companies are better. Now I really strongly feel small companies are better, and we're fighting super hard to keep the team as small as possible. We also decided to be co-located, which at the time when we started the company was a fairly unpopular choice. But again, that was just me deciding: do I want to spend my entire life on Zoom, or it's just not a choice I wanted to make at the time. So we're doing things like that differently. I still think realistically, to get good at something, you need to do it hundreds of times. I'm at, doing this the second time. So in all practicality, I'll probably just make a brand new set of mistakes this time. But we're there are definitely lessons we've taken. Like at Teachable, we turned on like marketing a little bit too early. At Carry, we didn't spend any dollars on paid marketing for the first 2 years. We wanted the product to actually get good and feel good, and we're only doing that now. So I think a lot more intentional about like things like what our cohorts look like, what our retention looks like, and things like that.
How many customers are you guys at now?
We're at 1,820. I can tell you, yeah, exactly, because I have dashboards I look at all day. We're a very seasonal business. We'll be about 3,000 by the end of the year, since like a lot of people sign up for solo 401ks like the last few days of December.
Their money into
Yep.
into the right place.
Yeah.
And then will people unsubscribe for the rest of the year? Is that like a problem that you see?
So it's very simple. If people deposit dollars, they almost never unsubscribe. If they don't, like our retention is about 50-60% after a year. So the game in turn becomes, how can we get people to actually contribute dollars? In an ideal world, set up a recurring deposit, then they're sort of customers for life.
How many people on your team now?
We're 14 right now.
Okay. And how are you acquiring customers? I mean, 2,000 customers, quite a few for somebody who just turned on marketing. What's been working for you guys?
The only thing we really do is content, like social. Again, I tweet about taxes a bunch. That funnel works pretty well. But if you look at our data, it's mostly just like organic referrals. But content and referrals are a big, big part of it. In the future,
People searching on Google or people asking their friends?
people hearing about it from a friend, like we survey people right after they sign up, say asking them how they heard about it. Almost half the people say from X person. X person is typically another customer.
Hmm. And what were you saying about the future?
In the future, we have to innovate and find channels, and that's sort of the work we have to do over the next couple of years.
Um, Plugging into like RIAs or other accountants is a viable option.
100%. Both of them are. We both of them actually have a different go-to-market motion. For RIAs, I think we need to build better tooling because they want to be able to like invest in portfolios, charge an AUM fee, and so forth. CPAs are typically a little bit more hands-off, so for them it's more of a referral sort of motion. But we are doing that. We've also unintentionally discovered demand for other products. Like for instance, most people hate their CPA, and we're trying to see what can we do over there. Most people say their CPA does no proactive tax planning. Most people have, yes, we're stumbling on other kind of interesting insights as we go along.
I feel like I learned that QuickBooks, like when your CPA says, okay, you should use QuickBooks for your business, only years later that I realized that like QuickBooks was reselling through our CPA, and our CPA was, I think, getting like $10 a month
Crazy.
off of us, and they have like thousands of customers. Is that correct? Is that how that works?
It really depends. A lot of CPAs do not want to get that commission. Like we offer it to them, but a lot of them say, I'd rather have that discount go to the end customer. But we give the CPA a choice. We're like, hey, if you're our distribution mechanism, we can either give you 20% or you can give your customers 20% off. And interestingly, most choose the latter.
Is your current customer acquisition funnel of doing mostly like social compared to Teachable? Was that a tool you guys used back then, or
It's very
not?
similar. Like we still use a lot of live workshops. Like at Teachable, webinars were a little bit more popular at the time, but we were able to convert at its peak almost like 20% of live registrants would buy a paid Teachable plan. Those numbers have come down a little, but we still use a lot of live workshops. Um, the insight to Teachable that worked really well for us is we found the best customers at Teachable in turn had thousands of people in their audience that were qualified to be Teachable customers. That mechanic isn't as strong at Carry, but what's better at Carry is like the inherent stickiness of our product is more than what we saw at Teachable. At Teachable, because people had to learn how to make money online, a lot of them never even got to that point.
webinar flow. So you guys would run an ad that says, hey, we're hosting a free webinar to teach you how to make money online selling courses or something like that.
So
People would join, you do like a high value webinar, and then a lot of them would sign up.
yep. So the default one we ran at Teachable is we had a free plan. Our free plan at scale would produce maybe 150, 200 leads a day. Until we did the webinar, we were really bad at converting them. But what we then did is every Thursday, and for a while, every Tuesday and Thursday, we did a live webinar. All the free leads were invited. We gave them a really high quality presentation, a limited time offer for buying Teachable now. Like, I think we gave them extra content and stuff. Uh, and then very reliably, every Thursday at 2 p.m., we'd get 40 to 50 new paying customers. And the whole thing was relatively automated, except the delivery. We had the emails going out. The offer ended. The cart closed every Sunday, but kind of on infinite loop.
Earlier, you were talking about how Carry's a more capital intensive business than Teachable was. Can you explain what you mean by that?
Yeah, it's not crazy capital intensive, but there's this whole like meme going around on Twitter where startup founders are saying we're not doing this because it's easy, but because we thought it would be easy. And a lot of parts of Carry do feel like that. I thought it would be a substantially simpler business to build, but as soon as you get into like dealing with money and the regulated nature of the business, it's hard. Like, again, for instance, we have an RIA entity. We need to spin up a broker dealer entity. At some point, we may need to buy or become a trust company. There are all these really hard parts that you have to do well in order to build a really nice customer experience. And it's very different from like education where you can somewhat move fast and break things. Here, you can't do any of it, right? Like, we're getting like, I joke that we're on a path to being regulated by every government agency, but we have a tax practice that the IRS looks at. We have an RIA that the SEC looks like. FINRA is looking at a broker dealer application. We're doing 401k plans, so it's employment law. So every piece of this, there's real hard work and regulatory pressure to do things a certain way.
Definitely didn't take the easy path
Yeah.
with this business.
Yeah.
So I'm sure did you end up raising capital for it?
So I had my own fund from which I incubated it, which was kind of interesting, where I took $2.5 million from our fund and I at a very low valuation. Basically the fund owned 20% of the business outright. So I started it there. Then I did a small friends and family round where I actually got 200 people to invest a maximum of $10,000. It was because we had enough people, and I wanted people to have upside, but there was a lot of demand. So small checks, but a lot of people. And then we just raised a $10 million Series A, but we're operating the business as if this is the last money we'll ever raise. So this is it, basically.
Can you share like how much you're burning per month?
Yeah. So our burn right now is about 160K a month. We have a little bit over 10 million in the bank. So 5 plus, and I'm comfortable taking my burn to like, let's say 200, maybe even a little bit more. But that's still 4 or 5 years of runway. So, enough time for us to kind of bridge the gap.
Sense of how many
And that's net burn. Our revenue right now we're at about 100K a month in revenue. So gross burn is twice that much.
Do you have a sense of, I guess I could do the math, but do you have a sense of how many customers you guys need to be at to break even or to be kind of substantially profitable?
I think at the tens of thousands, the math starts making sense. It also just depends. I also think we're going to get substantially better at monetization. Like right now, monetization is not a focus, but I know you can keep monetizing better in the future. But my guess is not next year, but sometime late the year after is sort of where the graphs could intersect.
I can totally see how the value accretes, as you start being a custodian for hundreds
there's
of
nothing
millions
correct, and there's this is sort of business. It took a while to get started, and it was hard early on when you feel like, oh, it's been a year, we're only at like 30K MRR or whatever. But now it's going to get good, and it just gets better every single year. At a certain point, like, you just have to not mess it up for it to be a really good business. We're not there yet, but at some point the value just keeps building.
What percentage do you think of your customers came just from Twitter?
It's too high right now. I would say it's almost like 1 in 5, 1 in 6. Yeah, it's too high. Also,
customers came from there.
correct.
Yeah.
It's too high only because Twitter is also, I mean, we're both very active in it, but it's a little bit of a bubble. It's, it's at least an order of magnitude smaller than all of the other bigger networks. And, but it was very critical, and it still also helps with like recruiting employees and things like that.
In media setup behind you? Does that mean you're doing more video, Instagram, TikTok? Like
We this is
what
more
are you
for
doing right
this
now?
is more for courses. We invest a bunch in education on the platform as well. And studio space in New York is expensive enough that this is my office at my house, and I've just converted it to a little studio that the team can use.
I mean, right now I just have this one video, but I want like
It's
two chairs. I want the
I mean, that's the
recording
benefit.
studio.
I've basically made our entire office. Our office is in Williamsburg, which is a very popular decision for half the team and not so much for the other half of the team. And I happen to coincidentally live in Williamsburg, so it's the least I could do is offer a little studio space in return for keeping the office a walking distance away.
Like you gotta prioritize yourself sometimes, and that's okay. Um, let's see, where should we go? Oh, random question. I'm curious, how much did you pay for the carry.com domain?
So I signed like very, very strict binding paperwork that doesn't allow me to, but it was a six-figure sum. It felt very substantial at the time, yet like to me it was a complete no-brainer because you think about as an investment platform, trust is the most important thing, and our conversion rate across everything went up. Like traffic to email, email to paying customer, everything went up. So to me, it was a no-brainer.
You saw kind of a notable change. What was it before? It was like something Ocho, wasn't it?
It was ocho.com, which also, by the way, I like the name. It's less sexy than carry.com. But we actually got a lawsuit from another company called Ocho. And we may have been able to win the lawsuit, but it's just like, dude, like it's so distracting. And, at the time we have 400K in ARR. It's like, I don't care enough about the name. Easier to rebrand. And we still own the domain name, and I can still go ahead and start a, wine company or whatever, but just need to stay clear from financial services with that name. So just rebranded. I actually did that at Teachable too, where we used to be called something else before. So it felt like an omen that, this is a rite of passage.
A big believer in having like a simple .com name. We don't, but many of our companies do. So
Correct. I
I
mean,
think it's
you're, again, like, for my fund, I never really cared. And if you're a holding company, it really doesn't matter. But yeah, the net end product, I think it makes a big difference.
thing out of the fund, or what did you end up doing with the fund when you focused on this company?
So I tried for about a month. Initially, I was like, I'll incubate the company, I'll run the fund, I have infinite time. Very early on, like within 2 months of running the company, I'm like, this shit's hard. Like, you have to be all in on something. So what I did is we had raised a $72 million fund. I'd called 60% of the capital. We'd invested most of it. I basically canceled the two pending capital calls. So I effectively shrunk the fund by from 72 million to whatever 40 million and something. Um, if investors had pre-funded the entire thing, they literally got a wire back, and most people were pretty happy about it. It was a time venture. A lot of people were also feeling like they over allocated to venture, so it was nice for them to have money back. I still have a couple of $1 million left in the fund from the old capital call. I'll maybe make an investment every 6 or 9 months, but it's absolutely not a priority right now.
Balls from the sky.
Yeah,
You're gonna snap it up.
I think it's more likely I'll end up investing in fintech because now we look at vendors and tools and platforms all the time. Um, but I will say the thing that allowed us to do that is we're the only fund I know of that size with zero management fees. So it didn't feel hard to like give that back. I bet if you're taking fees, it feels like money you've earned that you're sort of returning. For us, we had no fees, so it was pretty easy to do.
Are like a drug. They're so addicting. I had a VC. My first small VC fund had no management fees. My next
Mhm.
one had management fees. That was my first experience with them, and I was like, wait, like I'm just gonna get this payment quarterly, and the next time I raise a fund, I'm gonna get
Yeah,
double, and the third time I raise a fund, I'm gonna get triple.
and they
So
stack.
yeah, and I could see like why. I guess I could see why like fund management was really the best business model to be in.
I still think there's a not insignificant number of people that don't understand venture fund economics. Like a lot of people still think they don't understand like the 2 and 20 is really 20 and 20 or sometimes 25 and 20 or whatever. It is very, very substantial. And in venture specifically, there's no shortage of like old school $1 billion funds have the same LP relationships where the partners have gotten very, very wealthy over 20 or 30 years while like basically underperforming the S&P, just stacking these massive funds and fees and all of that.
My friend worked at Bessemer, and I think their management fee was like 3.5% or something
Yeah,
like
it's
that, which
crazy. I also
is
think they take
insane.
30% or carry, if I'm not
That's right.
mistaken.
That's right. Yeah, we in Enduring Ventures we don't do any carry or management fee dynamics.
What's the
But it
model?
wasn't easy to just get off the
What's the
the
model? Because you're pretty involved. Well, it's you're pretty involved in the actual operations as well, right? So how do y'all make money?
C corp at the top. So we look like a
Okay.
baby
Oh, of
Berkshire
course.
Hathaway.
I
Or
remember your that was my first exposure to your content. I saw the thread of yours that went very viral and it was great read.
and I think we have two. We each have a thread that's gone pretty viral that overlaps in some ways. Ours is from the holding company
Mm-hmm.
perspective, talking about the value of C corps and
Mm-hmm.
QSBS and dividend reinvestment. And you also have a couple QSBS
Correct. But
threads, right?
mine is much simpler than yours. I've never gotten into companies owning companies, like multiple layering and structuring. That's well above my pay grade.
Because we're in the business of buying companies, you just have to be careful because there's a variety of categories that can break your QSBS eligibility, right? So you can start in one area and end up in a place where you're no
Correct.
longer QSBS
Correct.
eligible.
It's also, from what I've seen, QSBS is a stance you take. So there's a lot of businesses where like services businesses are no good. Tech enabled services, you can argue it's a technology company and so forth. But a lot of this ultimately is sort of untested. Like one of the things, like I know a lot of investors have taken the stance that your QSBS clock starts with a safe, which I think it may not, but people take that stance and kind of none of this has been challenged and there's no sort of case law to prove it either way for now.
I thought the clock just started when you form the C corp. Is that not true? Oh, you're saying
So
for the
for
investor.
the investor,
I
for
got it.
you as a founder, absolutely. For it's typically when you own shares. But what happens when you invest in a safe that doesn't convert for 3 years? Some investors have taken the stance because the safe is almost a form of equity, like it literally says future equity, it counts. Other lawyers say no. So really it's all opinions at this point.
For people listening, can you give a quick summary of what QSBS is and why we're chatting about it?
Absolutely. So I call QSBS the most generous tax break in America, but it stands for Qualified Small Business Stock. It was one of the things that radicalized me and ended up with me building Carry. I was running my company Teachable for so long, had no idea. A few months before selling, I found out that I wouldn't have to pay taxes on $10 million when I sold the company, which was absurd, right? Like it's a $10 million, no federal taxes because I live in New York, no state taxes. Where it got wilder is the QSBS limit applies per company per shareholder. So a single shareholder can invest in 5 companies and get a $10 million limit with each company. But also within a company, each shareholder gets their own limit, which means you can give shares to your family members, your children. You can set up trusts. Each of them get their own $10 million limit. So a lot of times founders have been able to pay no taxes on 30, 40, $50 million.
When do you have to give those shares to your family members or trusts? Do you have to do that when you first start the company, or can you do that later on
You
and
can
it's
do that
still
later
considered
on.
aged QSBS stock?
Yeah, it's already vested. The only consideration you have is it counts against like your lifetime gift tax exemption if the value is too high. So if you do it when it's worth millions of dollars, it comes against your gift exemption, but otherwise it's fine.
And what about if you have a wife or I guess if you're married, is it still up to $10 million? Do you gift it to the person? Do you get up to $20 million?
I think with your spouse, it doesn't work just by directly giving it to them, but you can do what's called a slant, a spousal lifetime access non-grantor trust, and that gets you another 10. But each child gets you a $10 million limit.
There's another level to this, which is if you have an LLC that is worth, let's say 5 or $10 million, and you convert it into a C corp. Can you talk through that briefly
Yeah.
too?
So the way the law is written, QSBS is an exemption for $10 million or 10 times your basis. And the way the LLC workaround works is if you have an LLC that gets to a value of 20, 30, 40 million, you then convert it to a C Corp. That becomes your basis. So you then get an exemption for 10 times the basis. So uh, you could theoretically use this to get almost $500 million tax free when you sell the company. With that said, I've literally personally only met one person who's actually done this because it's pretty high risk. I mean, your clock doesn't start until you actually flip it. And it takes a lot of planning to think that big and that deep. And um, it, it could end up misfiring. Like if you only sell the company for 40 or $50 million, you get no QSBS because that's just your basis.